Hello, welcome to chapter 15. This time we're going to do something a little bit different. We're going to work with MindTap and the adaptive test prep. You can take this test if you like. Um, so what we'll do is go back to the first question. Goods that are used as inputs for the production of other goods. If you remember from class, these are called intermediate goods. Okay, an example of that would be a tire made at the Goodyear plant that was sold to Honda. That sale would not count towards GDP because that is an intermediate good. That tire is going to be put on a car, which is going to be sold to a consumer. And when the consumer buys the car, the value of the tire is already incorporated into the car. The next thing we've got here, GDP chain price index is also called the GDP deflator. Okay, if we take nominal GDP as it's calculated, that's where we add up the market value of all final user goods and services produced within a nation's boundaries during a period of time, usually a year. So we take that nominal GDP figure as we calculate it. That's in this year's dollars. You divide that by the GDP chain price index, and that will give you real GDP, which we can compare year to year because it's all in the base year's dollars. Next thing here, and this is something we're new. We're going to work on calculating different components of GDP. The value of this country's net exports is. Now, if you'll remember, net exports is equal to exports minus imports. So we go to exports here, that's 55 billion, minus their imports, 23 billion. That's going to leave us $32 billion, and they're in the positive. Okay, if imports were greater than exports, then it would be negative. So we're going on to the next question here. The purchase of new office space by a software firm would be included as blank in gross domestic product counts. That is going to be called investment. Okay, since the software firm is going to use that furniture, they're the final user. They're the purchaser of a final user good or service, and that's called investment. When a business buys final user goods and services. Okay. Now here we're going to use the expenditure approach. The expenditure approach to GDP says that GDP is equal to C plus I plus G. We've got two G components here plus NX, net exports. So we take $1,000 in personal consumption expenditures plus $100 in net exports plus $200 in federal government consumption and gross investment expenditures, $400 billion in state. We don't worry about imports, that's already included in net exports, and then the $75 billion in gross private domestic investment. So, excuse me, here we're going to have 1775. So that's $1,775,000,000,000. The next thing, in the expenditure approach to the computation of gross domestic product, the sum of fixed investment expenditures and changes in business inventories represent gross private domestic investment. Okay. And that's investment spending. Next thing we have, gross domestic product is expressed as blank using the expenditure approach. C plus I plus G plus net exports. Net exports is exports minus imports. All these have negative signs in there. We don't have any negative signs except inside that net export calculation. Next thing we have here is a positive net export figure implies that the value of exports of a country exceeds the total domestic investment. Positive net exports, the value of exports of a country exceeds the value of its imports. That's the correct value, correct answer. The total domestic investment in a country exceeds the value of exports. The value of imports of a country exceeds the value of its exports. None of those are true except for that one. Net exports is exports minus imports. If exports are greater than imports, then that's going to have a positive value. If imports are greater than exports, then we're going to have a negative value for net exports. If we computed GDP using the expenditure approach and then computed it using the income approach, which of the following would be expected to be true? GDP computed from the expenditure approach will be equal to GDP calculated using the income approach. That's what's expected. It doesn't always work out that way because of black market transactions and some other things. The circular flow model is based on the assumption that the total value of intermediate goods is not included in the calculation of a country's gross domestic product. The factors of production are owned by households. That is the correct answer. Okay. We'll submit and review. We better have got them all right. We got 10 of 10. Okay, we're doing great. So I'm trying to keep these videos short, under 10 minutes. There's 5 minutes of the mind tap stuff. I'm going to pause here, and then we are going to use the PowerPoints for a little bit, and I'll get this under 10 minutes. Thanks. Okay, here we go. We're going to use the PowerPoints for about 4 or 5 minutes. First thing I want to show you here, that is the most important equation in all of modern macroeconomics. C plus I plus G plus NX, which is exports minus imports. You've got to have that equation memorized. You also have to remember. Okay. When we look at this equation, this is also the equation for aggregate demand. And remember, consumer spending is generally thought to be fairly rational by Keynes. Keynes thought that consumption spending, that we had some fixed amount of money we were going to spend, what we call autonomous consumption, and that's C sub 0, plus induced consumption. He thought we acted like little robots, that every dollar we got in after-tax income, or what we call disposable income, we'd spend a fixed proportion of it, say 80% or 0.8, and then the rest we'd save. 20% or 0.2. So every dollar comes in, you act like a little robot, you spend 80 cents, you save 20. Government, Keynes thought that governments were sort of super rational, that they could come in and counteract decreases in spending by businessmen, who we'll get to in a minute, are irrational. Keynes thought that business spending was irrational, that was driven by animal spirits. That's the problem. That's one of the causes of the business cycle, is this psychological explanation of business spending. He thought that business spending was irrational, that businessmen were guided by animal spirits, and that they would overspend. That would cause a boom. Maybe they get a little good news, they overreact. That would cause a boom, cause I to go up. That would cause aggregate demand to increase and GDP to go up with it. Keynes thought that when businessmen got a little bad news, that they would sort of overreact and stop spending or cut their spending drastically, and that would cause GDP to go down, and that would cause the recession or the bust. Keynes thought that government could counteract that by increasing spending during a bust to make up for the lack of business spending, or by cutting their spending or increasing taxes during a boom to offset the increase in investment spending. Okay, here we've got gross domestic product using the expenditure approach. Got to get myself out of the way here. Okay, if you look here, the largest component of, I can't find this place to put myself, largest component of gross domestic product is consumption spending, 69%. Gross private domestic investment, I, is about 16% in the year 2014. Government expenditures, 18. Net exports, -3, because we import more than we export here in the U.S. The income approach we went over in class, but I'm going to briefly cover it again. This is the method that measures GDP by adding up all incomes. Every dollar spent should theoretically equal every dollar spent, minus a few exceptions. So the income approach should give you the same number as the expenditure approach, which we just looked at. So here are the components of GDP when we use the income approach. Compensation of employees, we abbreviate that with a W. That's wages, salaries, and other compensation. That includes benefits you receive at work, like if your work pays for part of your health insurance, that's included in compensation of employees. Also, there is a 6.5% Social Security tax that you pay. but your employer matches it. That match doesn't show up on your paycheck, but that's included as compensation to employers. Rents are fairly self-explanatory, plus plus business profits. That includes both corporate and sole proprietorship profits. Net interest, that is the interest payments made by businesses and governments. We subtract out interest payments from consumers when we look at gross interest, because that's one consumer paying it to another theoretically, because all savings belong to consumers. Then we have two non-income adjustments: indirect business taxes, such as sales taxes. These are taxes calculated as a percentage of the cost of goods sold. And depreciation, that's where capital goods wear out. That comes off of net profits, but no one receives a check for it. So we have to add depreciation back in. Okay. I'll just let you read these. This is compensation of employees. That's abbreviated with a W. Okay, find a nice spot for me there. Okay, income earned from wages, salaries, and certain supplements paid to labor. I've explained those to you. Rental income. Don't forget, rental income includes royalties, which are payments for patents and copyrights. The two non-income adjustments, these should be profit: proprietor's income and corporate profits. Depreciation. Okay. When we look at gross domestic product, compensation of employees is the largest portion. That's 53%. Rental, very small, 3. Profits, 20. That includes both proprietor profits and corporate profits. Net interest, again, is small, 3. Indirect business taxes, 8. Depreciation, 13. These two approaches should be equal. C plus I plus G plus net X plus NX, net export, should equal WR pi NI, indirect business profits, and depreciation. Those should equal. Okay. Here's an international comparison of GDP from 2014. If you look here, US, large is 17.4, followed by China at 10.3 trillion. These are trillions of dollars. Okay, Japan 4.8, Germany 3.8, United Kingdom 2.8. There's Russia. Yeah, we gotta be scared of Russia, don't we? We have more than 8 times the GDP of Russia. If you look at defense spending, the US spends more on defense than all the rest of these countries combined. There's some shortcomings to GDP. It does not take into account non-market transactions. If you mow your lawn, does it count towards GDP? You pay somebody to mow it, counts towards GDP. You barter with your neighbor, doesn't count towards GDP, even though something was produced. The distribution, kind, and quality of products. Let's say the government spends $1 billion a year to pay someone to follow you to make sure you're not committing some nonviolent crime like using drugs, and you're not. Even though that $1 billion wasn't really productive, it still counts toward GDP because it was paid for by the government. That would be the kind and quality of products. Okay. Neglect of leisure time and underground economy doesn't get accounted towards GDP. And then we don't subtract out economic bads. If I produce something, say in a factory, and I pollute your farm and I cause $10 million in damage, the $10 million in damage is not subtracted from GDP. That's an economic bad. But if you sued me and I paid $10 million to correct the pollution damage I did, that would count towards GDP. So if you look, there's a wash: 10 million in damage, 10 million I paid to fix it. Nothing new was produced really, but it would be a $10 million addition to GDP. Okay, and GDP is a quantitative rather than qualitative measure of the output of goods and services. This is another shortcoming of it. Finally, disposable income we've talked about in class. I'm not going to go over these. Nominal GDP and real GDP. There we go. Nominal GDP is the value of all final user goods and services based on the prices existing during the time period of production. Real GDP is the value of all final goods and services produced during a given period of time based on the prices existing in a selected base year. We pick that base year arbitrarily. The GDP chain price index is what we use to compare changes in prices of final user goods and services during a given period to the prices of the goods in a base year. Real GDP is equal to nominal GDP divided by the GDP chain price index, and then we multiply it by 100 to make it look pretty. When you use those numbers, you have to remember first to divide real GDP. I'm sorry. Here we have to multiply by 100 because we used the 100 in this GDP chain price index. That gets rid of the pretty 100 we used down here, if you remember from class. Real GDP and nominal GDP, you can see the base year here is 2009. In all years prior to 2009, real GDP is above nominal GDP. In all years after, nominal GDP is greater than real GDP, and that is because of price inflation. Okay. Here, if you look here, nominal GDP divided by the GDP chain price index, that will give you, multiplied by 100, will give you real GDP here. So we took 1,076. I'll get my calculator out here, if I can. Get out of that. Okay, we'll get our calculator out.